Hey there, happy Friday, dividend growth stock investors. It's Colby, the DGI Crab, coming at you with the Friday video where I go over each of the four tiers to figure out where the value in the stock market lies. If you are a first-time viewer of the channel, I only cover 60 high-quality dividend growth stocks, and I've split them into four separate categories or tiers based off of the age of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration when trying to decide how to best build up their passive income. Getting up close to the end of the year, but I encourage you all to continue to stay focused and push through the holidays. This could be a difficult time to invest with all the extra expenses of gift giving and travel for some of you. But stay focused, keep pushing through to the end of the year. If there's any final goals for 2024 that you are looking to hit, running out of time. So definitely stay dialed in. Now, I am not a professional financial advisor. The content of this channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. And in case you are new to the channel, I do go over the DGI Crab allocation strategy, where I put a minimum 50% into age-appropriate ETFs for automatic diversification. And I'm looking for stocks yielding 30% or more above their 4-year average yield as my primary metric. Now, if one of my top 10 favorite stocks is yielding just 20% or more above the 4-year average yield, I will go ahead and add those at that point in time. I will remain within my tier unless there happens to be a stock within a different tier that's yielding 50% or more above their 4-year average yield. At that point, it just would appear to be too big of a bargain to pass up. And then finally, if there aren't any stocks within my age tier that meet that criteria, then I will just add even more to ETFs for that particular time period. So that is the strategy, you guys. Now let's jump into the DGI Crab spreadsheet and take a look at each of those four tiers. So for tier 1, for the 18 to 30-year-old investor, we're looking for stocks yielding generally in the 1% to 2% range with at least a 10%, if not better, annual dividend growth rate. Now, as Nike has been all by itself for a little bit here as the only stock in the tier that hits that 30% or more undervalued metric. Now, I'm focusing in here on the valuation metric where I'm comparing the 4-year average yield to the current day yield. Nike is still far out in front on that list until it recovers and gets itself up out of the 70s and more back closer to 100. It's probably going to keep that number one spot. The 4-year average yield does continue to very gradually climb up. However, it is a very gradual climb, very gradual process, and you can still get Nike right now yielding above 2%. I really like that quite a bit. And then Nordson is back into that number 2 position after reporting disappointing earnings for Q3. You can get Nordson, one of the longest Dividend King streak histories of nearly 60 consecutive years of increasing that dividend, for a 1.38% yield when typically it doesn't even yield as much as 1% across the 4-year average yield. And this is one that typically will grow that dividend in the anywhere from 13 to 17% range. So definitely a good opportunity to get a major growth compounder with Nordson and UNH with all of that tragedy and drama going on around that company. They have definitely dropped and price corrected a bit, still not quite to the point where I'm ready to jump in and start adding shares of it personally, but definitely keep an eye on that. If UNH continues to slide and get down closer to $500, that's going to look like a pretty nice buying opportunity to me. Tier 2 for the 31 to 41-year-old investors, where we're looking for starting yield more in that 2 to 3% range with maybe a 7 to 10, 11% dividend growth rate. And for this tier, Hershey and Target are still in that buy zone. There's been some noise around Hershey and some rumors that Mondelez may be attempting to acquire Hershey again. I did do a video on that just yesterday. If you haven't watched it, go check it out. But that doesn't really do anything whatsoever to dissuade me away from Hershey. Nothing's happened with it just yet. If there is an acquisition that happens, I'll cross that bridge when I come to it. For now, it still looks like it's very undervalued. 4-year average yield of 2.03%, and it is right now currently yielding 2.99 at the end of the trading day. Target, a full basis point higher yield than its 4-year average, 3.33 today, 2.33 4-year average. That looks pretty good to me. Moving on to Tier 3, 42 to 53-year-old investors looking for 3 to 4% starting yield with 5 to maybe 8% dividend growth rate. Archer Daniels Midland still cannot get out of their own way. That stock continues to languish down here in the low 50s. And at those prices, I am definitely buying. And in fact, it is also in that 50% or more undervalued category, same as with Nike. So this is one that for me looks like a great deal for any and all of the age ranges. Hormel has had a nice couple of weeks here of late after dipping down below $30 a share there for a little bit. Has climbed back up. It has been getting more into that $33 range. Still looks like a nice buy, but it's starting to get to the point where it might slip out of the buy zone. Not just yet. Still needs to go up another dollar or two before it gets there. A 2.6% 4-year average yield. You can get that yielding 3.52 right now. And then GPC kept getting into that buy zone just barely. It's at 29.4% off the 4-year average yield. GPC, one of the longest consecutive dividend growth streak companies with 67 years, going on 68 now. You can get them at 3.3% starting yield when they typically, over the 4-year average, yield just 2.55. So these are the kind of bargains that we are looking for so we can get the starting yield where we want it for each particular age range. For Tier 4, age 54 and older investors, Realty Income still sitting on the top of the category. Not a great deal, but a shout out to my guy Nathan Robert. If you haven't checked out Nathan's channel, you ought to go and take a look at it. He is a younger investor who's just doing a great job of putting together a nice group of stocks, most of which that pay a dividend. He did a video on Realty Income just the other day that I thought was excellent. You all should go check that out. It looks like it's definitely in his buy zone, and he takes a deep dive into just what the heck they're doing and went over their earnings report and all of that stuff. So definitely could do a lot worse than Realty Income in the $55 range. I personally would still wait for it to get just maybe a little bit cheaper than that, but certainly not a terrible deal, just right at about 20% undervalued. And for those Tier 4, 54 and older investors, just by the way, we're hoping to at least get a 5% starting yield, if not better, and a growth rate that at least is going to keep pace with normal years of inflation, so like 2 to 4%. I do keep a separate tab just for my top 10 favorite stocks. Now, these aren't new stocks. You can find these between Tiers 1 and Tiers 3, but this is the group that, for me personally, I will go ahead and get them if they hit that 20% or more undervalued. And Pepsi and Johnson & Johnson remain there in that buy zone for me. Those are both Tier 3 stocks, but I would be okay with anyone of any age adding them at this point in time. Nothing wrong with building up positions in companies like that. So the strategy for the week would look like this for each tier. So starting with ETFs, where I said 50% at minimum goes into ETFs every time you would invest. For the Tier 1 folks, would do 25% into the S&P 500, 15% small cap value, 5% dividend appreciation, and 5% international. Just a reminder to everyone, VYMI, Vanguard's high dividend yield non-US ETF, is the only non-US stock holding that I have, and I do 5% just across the board, no matter the age. It is higher yielding, so the younger investors could rejoice a little bit that that I would give the thumbs up for something that yields up above 4% for them, but going to get a lot of diversification there. Now, for these are my preferences on the ETFs. Obviously, like for VOO, there's SPYI, there's IVV, just an S&P 500, and then like for VIG, somebody asked me pretty recently, why I prefer VIG over DGRO. You could do either or. I like them both here. I give VIG a slight edge, but DGRO is also very similar in terms of what we expect it to do with the higher dividend growth rate and a lower but still pretty respectable starting yield. Tier 2, same 4, just switched up the order a bit, putting more emphasis on the dividend appreciation and a little less on S&P 500 and small cap. Tier 3, VYM, SCHD, DHS. These are my 3 favorite higher yielding ETFs that still provide good dividend growth. And then for Tier 4, we would have a high yield stock category like SPYD and alternative investments with higher yield that go outside of just your typical, blue chip, large market cap type stocks that I focus on. Getting high yield bonds, preferred shares, MLPs, covered call ETFs, and of course, international remaining at 5%. And just as a reminder, I did switch JEPI over to JEPQ recently because I'm getting with SPYI an S&P 500 covered call ETF, and with JEPQ I'm getting a NASDAQ 100 covered call ETF. So those are a pretty nice pairing. And then Devo, of course, is I think really set the standard for what a quality covered call ETF ought to look like with their own unique strategy. They give you good solid yield and yield growth, not as high as JEPQ and SPYI, but got to have a little bit of growth in there as well. And then for the individual stocks, so this is how I break it down for tiers 1 through 4. So for tier 1, because Pepsi and J&J are in my top 10, even though they're tier 3 stocks, I do 5% each into those two. I put a lot of emphasis on Nike as the most undervalued stock in the category. That'd get 25%, while Nordson, the second most undervalued stock in that category, would get 10. And then I'd also reach up to tier 3 again and do a little 5% into Archer Daniels Midland, which is still yielding 50% or more above that 4-year average yield. For tier 2, and this is my personal category, what I would do here is I've got this split out between 6 stocks. So I'd be doing 10% each into Pepsi and J&J, 10 each into Hershey and Target, the two ones in tier 2 that are in the buy zone, and then go down to tier 1 for 5% into Nike and up into tier 3 for 5% into ADM. For the tier 3 investor, so they've got Pepsi and J&J already in the tier, and then of course Archer Daniels Midland as well. I'm going to go 15% each into those 3 and still do a little 5%er into Hormel. Not totally ready to push Hormel off to the side just yet. There's still some more recovery that needs to happen there. And then finally for the tier 4s, since there wasn't anything in that category that hit my personal buy zone, again, maybe Realty Income is one that looks appealing to you if you really want to add some real estate to your portfolio. But I'm going to do an ETF double down once again in this category. Instead of going 15 and 5s, I'm doing 30 and 10s. And then instead of doubling down on VYMI, I'd keep that at 5%. And then for me, I'd be taking my pick for that extra 5% between Pepsi, Johnson & Johnson, and Archer Daniels Midland. I don't think you can go wrong with any of those 3 at these particular prices. So maybe lean into the one that you like the most, maybe add to the one that you've got the least amount in, whatever you think is the most appropriate for that particular grouping. And then finally, for the DGI portfolio here, with another $100 added to the portfolio, I did exactly what I laid out there in the tier 2 with putting 10s into Hershey, Pepsi, J&J, and Target, 5s into ADM and Nike, and then the ETFs, of course, with VIG, VOO, VBR, and VYMI, adding $2.54 of forward dividend income. And I've got 34 cents now of dividends for this brand new portfolio as well. All right, everybody, that's it for the week. Catch